Most people in India work for decades, but never feel financially secure. They earn more every year, but their stress also grows. Because income alone does not create wealth. A plan does. A system does. Right now, you may be saving something, investing a little, but without direction, money leaks silently. And 10 years later, you wonder where it all went. The truth is simple. If you follow the right plan for the next 10 years, you can build real wealth without guessing, without stress. No shortcuts, no hype. Just clarity, discipline, and time. Because wealth is not built by chance, it is built by design. And the next 10 years can change your entire life if you follow this step by step. Let's begin. This video is for educational purposes only. I am not a SEBI-registered investment advisor. This is knowledge, not personal financial advice. Markets carry risk. Returns are not guaranteed. Do your own research. Consult a certified professional if needed. Your money, your responsibility. Step 1. Build your financial base. Before you think about returns, think about protection. Because one emergency can reset your entire journey. Start with an emergency fund. Minimum 6 months of expenses, preferably 9 to 12 months. If your monthly expense is $25,000, target $1,50,000 to $3 lakh. Keep this money safe, not in stocks. Use a savings account or a liquid mutual fund. Next, insurance. Term insurance. Only if someone depends on your income. Choose pure protection, not investment-linked plans. Health insurance for yourself and family. Medical inflation in India is rising fast. One hospitalization can cost lakhs. This step feels slow, but it builds foundation. Without this, everything else is fragile. Step 2. Start your first SIP. This is where wealth actually begins. SIP, Systematic Investment Plan. You invest a fixed amount every month. No timing, no emotional decisions, just consistency. Start small, 2,000 rupees, 5,000 rupees, 10,000 rupees. The amount is not important, the habit is. Example, 5,000 monthly SIP for 10 years at 12% annual return can grow to around 11 to 12 lakh rupees. Increase this SIP slowly every year. SIP removes fear. It removes confusion. It builds discipline automatically. Start now, not later. Step 3. Build asset allocation. Never depend on a single asset. Divide your money. Equity for growth. Debt for stability. Gold for balance. Simple structure. In your 20s, 70% equity, 20% debt, 10% gold. In your 30s, 60% equity, 30% debt, 10% gold. Asset allocation reduces risk. Even if markets fall, your entire portfolio doesn't collapse. Most beginners ignore this. They chase returns and take hidden risks. Balance creates stability, and stability creates confidence. Step 4. Understand risk cycles. Markets move in cycles. Growth, correction, recovery. This repeats. In a bull run, everything looks easy. In a crash, everything feels wrong. This is where people quit. But smart investors stay consistent. If your SIP continues during a market fall, you are buying more units at lower prices. This is called rupee cost averaging. It reduces your average cost. Volatility is not danger. It is opportunity, if you stay calm. Step 5. Rebalance yearly. Every year, review your investments. Check your allocation. If equity becomes 80%, reduce it. Move some to debt. If equity falls to 50%, increase it. Buy more. This keeps your risk aligned. Rebalancing forces discipline. You sell high and buy low, without emotions. This is a simple habit with powerful impact. Step 6. Understand taxes. Taxes reduce your returns. You must plan for it. Equity investments. If held for more than 1 year, long-term capital gains apply. Up to 1 lakh rupees gains tax-free. Beyond that, 10% tax. Short-term gains taxed higher. Debt instruments taxed as per your income slab. Use tax-saving tools. ELSS mutual funds, PPF, EPF. These reduce tax burden. Higher post-tax returns mean faster wealth creation. Step 7. Avoid common mistakes. Trying to time the market. Waiting for the perfect entry. Stopping SIPs during fear. Investing based on news. Buying too many funds. Checking portfolio daily. Comparing with others. These destroy wealth. Keep it simple. Few investments, clear plan, long-term focus. Avoid noise. Focus on process. Step 8. Increase income and SIP. Your income will grow. Your investments must grow faster. Every salary hike, increase your SIP. Example, 5,000 SIP today, 7,000 next year, 10,000 after that. This is step-up SIP. It accelerates compounding. Also focus on skill growth. Better skills, higher income, higher investments. Upgrade lifestyle first. Upgrade assets first. Step 9. Scale after year 5. First 5 years, build discipline. Next 5 years, build scale. Increase investment size. Add index funds, low cost. Consider direct stocks only with knowledge. Diversify across sectors. Do not rush. By now, your portfolio has momentum. Compounding starts showing results. Stay consistent. Don't get overconfident. Step 10. Build long-term mindset. Wealth is slow. It is built quietly over years. The first 1 lakh rupees takes time. The first 10 lakh rupees feels faster. Then it accelerates. This is compounding. Stay invested for at least 10 years. Ignore market noise. Ignore short-term losses. Focus on habits. Discipline beats intelligence every single time. If you follow this plan, you won't feel anything dramatic. No excitement, no sudden wins, just steady progress, month after month, year after year. And one day you notice something. You are no longer worried. You are in control. Your money works for you, not the other way around. This is what real wealth feels like. Quiet, stable, strong. Your future self will thank you, not for big decisions, but for small, consistent ones. Start today. Stay consistent and let time do its work. Step 11. Control your behavior. Money is not lost in markets. It is lost in decisions. Fear, greed, impatience, these quietly destroy wealth. When markets fall, you feel like exiting. When markets rise fast, you feel like investing more. Both happen at the wrong time. This is the cycle most people never escape. So you need rules, simple rules, clear rules. Continue SIP no matter what. Do not sell in panic. Do not chase trending investments. Limit how often you check your portfolio. Once a week or once a month. That is enough. Because emotional decisions break long-term plans. Discipline is not about intelligence. It is about control. And control creates wealth. Step 12. Track your progress. If you don't track, you don't know where you stand. And if you don't know where you stand, you lose direction. So track your net worth. Every 6 months, not every day. List everything you own. Mutual funds, stocks, PF, cash, gold. Then list what you owe. Loans, credit card dues. Subtract liabilities. That number is your real progress. Example, assets worth 5 lakh rupees, liabilities 2 lakh rupees, net worth 3 lakh rupees. Simple, clear. Now, track this over time. If it grows, you are on the right path. Do not compare with friends. Do not compare with social media. Compare with your past self. That is the only comparison that matters. Step 13. Protect your gains. Making money is one part. Keeping it is another. As your portfolio grows, risk exposure increases, so you must protect. Not all money should stay in high risk. Gradually shift some portion to safer assets, debt funds, fixed deposits. Example, if your portfolio reaches 10 lakh rupees, you don't keep 100% in equity. Move some part to stability. At 25 lakh rupees, protect even more, because large losses hurt more and recovery takes longer. Wealth is not just about growth, it is about sustainability. Many people build wealth fast and lose it faster because they never protected it. Your goal is steady growth with controlled risk. That is real financial strength. If you follow this plan, you won't feel anything dramatic. No excitement, no sudden wins, just steady progress, month after month, year after year. And one day you notice something. You are no longer worried. You are in control. Your money works for you, not the other way around. This is what real wealth feels like. Quiet, stable, strong. Your future self will thank you, not for big decisions, but for small, consistent ones. Start today. Stay consistent and let time do its work.